All right, well, those are the headlines that we are tracking for you today on ET Now. Well, first up, let's address the AMFI data. In totality, mutual funds saw net outflows in the month of May. Equity mutual funds saw net inflows, which means investors put more money into mutual funds than they're redeemed. So the overall mutual fund industry saw net outflows because of debt funds. Massive net outflows seen in debt funds yet again. Let's first bring on board Jayesh Khilnani to take us through all the ups and downs seen in the AMFI data and the individual categories as well that stood out. Jayesh, over to you.
AMFI has reported great set of numbers for the month of May, despite the fact that there has been an overall outflow, but that has been largely led by the debt category. However, if you concentrate on the equity side, this time the inflow has surpassed 10,000 crores and the equity assets under management for the first time have surpassed 10 lakh crores. So if you have a look at the inflow number on the equity side, that's the highest since March 2020. And also if you have a look at the multi-cap category, that has seen an inflow of nearly 2,000 crores. But it's the broader markets that have stolen the limelight, because both the small as well as the mid-cap funds, they have garnered more than 1,000 crores each into their kitty for the previous month. For the small cap category, the inflow is the highest that we've seen since Feb 2020. The other categories that have seen healthy inflows are the focused funds as well as the sectoral or thematic funds as well. Interestingly, the fund of funds that are investing overseas, that has also seen an uptick to the tune of about 2.4 thousand crores, and that is the highest that we've seen in over a year. The SIP number also, that has been relatively stable at in excess of 8,800 crores as compared to 8,591 during the previous month.
All right. Okay, Jayesh, thanks so much for that. Let me welcome now on the show Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us today on the Money Show. I know we wanted to discuss about, the transparency that has been brought about by SEBI on debt funds. But first, I'd like to talk about this AMFI data that my colleague just, highlighted for us. Debt funds, again, have seen net outflows, more redemptions versus investments. This is a trend that we've been seeing largely all of this year. There was a blip in April. You could call it a blip because, for the last 5 months, it's just the month of April where we saw net inflows. So what explains this continuous or rather the more frequent redemptions that we are seeing in debt funds?
One is that investors are increasingly becoming risk averse. I'm not referring to the Franklin Templeton fiasco or whatever, but generally the decline in interest rates, and after that investors don't find it worthwhile to assume any unusual risk. So there is extreme risk aversion. So from all the categories, and if you look at it from that point of view, there are very few categories which is suited for the risk averse investors. Otherwise, the whole mutual fund industry or the fixed income category is configured as if every mutual fund or every investor is trying to optimize his return or maximize his return. And when we have an interest rate outlook like the one now, it's very difficult. In fact, the downside is much more likely than enhancing your return. So everybody is becoming risk averse. But the surprising thing is, and I have not been able to decode the reason, is that the maximum exodus this month is from liquid fund and overnight fund, which is anyway meant for risk averse investors. But if you look at the decline in the return of these funds, they have come to a point where, many investors would not even like to, if you have a modest sum of money, you might rather might as well leave it in your bank account than move it elsewhere.
Yeah, Dhirendra, we usually used to say that, okay, if you have money lying in a savings account, might as well park it in a liquid fund because it gives you that extra % or 1.5%. And plus, withdrawal as well is extremely easy. But now the return decline has been so large that we'd rather just let the money in a savings account be. Dhirendra, let's talk about then what we have seen happen in the last 1 year. Of course, the Franklin fiasco has, caused and spurred SEBI and other regulators as well to ensure they close all the loopholes that created this problem in the first place. So in the last 1 year, how have you seen debt funds become more transparent about the kind of risk they carry in their fund?
Oh, a lot has happened in debt funds. In fact, they were very lightly regulated, and in fact, they were very loosely classified. So if you look at the series of things, if you look at each and every step, it doesn't look like a big move. But when you look at all of them together, which in the context, right now, just before starting the start of this program, I was trying to, list all of them together, and it makes, let me just list it out for you. You look at the listing, which was the listing of wound up units on a stock exchange. So that was the immediate reaction resulting from the Franklin episode, that investors were getting stuck. So the listing was enabled so that anybody who's badly in need of money, he can find an exit route at some price. I don't know how successful it has been, but it was enabled. So that definitely reflected on SEBI being very proactive. But immediately after that, the revamped riskometer. Earlier, the riskometer was very simplistic. And then we realized that, the slotting of the Franklin funds, many of them were quite misleading, going by the kind of risk they were carrying and the way they were getting slotted. So the riskometer becoming dynamic. Earlier, riskometer was linked to the category. So if you are in a certain category, you were getting you were assigned a certain slot in the riskometer. Now the riskometer is going to be a very dynamic thing. Depending on the underlying constituents of your portfolio, depending on the risk, it will keep changing every month. Now the liquidity crisis which Franklin faced, every fund is a beneficiary by the kind of liquidity that has been enabled in every fund category, and nobody has to go and get a special exemption. Minimum of 10% exposure in liquid assets. It will reduce the return, but it definitely is able to withstand the kind of crisis of trust that the Franklin issue created. So the liquidity has been addressed moderately, and some fund companies actually sought a higher allocation to liquid assets, and they were allowed in a fairly express way, but a minimum of 10% exposure to liquid assets. So that's quite significant. Tightened rule for inter-scheme transfer. So that actually it is an early warning signal for the way I understand it, because earlier the money will move from one fund to another, or investors will pull out money from one to another, but the underlying assets will keep changing. So that was that. So this will actually turn out to be the tightening of the norms for this. It will turn out to be an early warning system. Fortnightly disclosure of portfolio for fixed income fund, that has come into force, and now people really see what is there. You don't have to guess and wait for the month-end portfolio. YTM disclosure of the underlying, and most recently, a few days back, SEBI came up with this risk class matrix for debt funds. Depending, it is very much like what we have on Value Research Online. You see a bond fund style matrix. So that box, the style box of a debt fund, where every fund gets slotted in one of the nine boxes on two dimensions. On one axis is the interest rate sensitivity, and on the other axis is the credit risk. So depending on where you are, high credit risk, low credit risk, or extremely low credit risk, and depending on the maturity of the portfolio, so investors will have a very precise sense of how risky the fund is. One thing which this risk class matrix does not really capture, which a risk which was clearly visible, or that is something which affected or which led to the the demise of these 6 Franklin funds, was the liquidity risk. Because liquidity is in a certain security is a moving target, and that is something which is not getting captured. But risk class matrix of debt, risk matrix of the debt funds, this is going to really bring about a far greater understanding of what the fund is all about.
All right, so many measures, listing of wound up units, replacing the most simplistic riskometer with one that's more dynamic, that takes into consideration every fund, the constituents of those funds as well, not just simply the classification by the mutual fund house of the fund, minimum 10% exposure to liquid assets, which may curb returns a little bit, but I think it'll withstand any liquidity problems. And then finally, this latest is that risk matrix that has been released. It takes into consideration credit risk, interest rate risk. It does not take into consideration liquidity risk, but I suppose we should, be seeing those products, I guess, develop over time. So today, Dhirendra, now, debt funds, any which ways, are a tad bit more complicated in the sense they have a few more jargons like duration, etc., which could explain also why retail investors don't tend to participate in debt funds. You will see more participation in debt funds by the more sophisticated investors or institutional investors. Now you have an array of information in front of you, fortnightly portfolios disclosed, plus these different risk disclosures as well. If you could put it in simple terms, that if I, as a potential debt fund investor, want to put my money, park my money for the short term, I am a little risk averse, what are the important pointers I should look at?
One is that, definitely individual investors don't have, the appetite for the bond fund is gradually growing, but it has not really been able to strike a chord with individual investors for a variety of reasons. One is that look at the decline in return of the liquid fund. So if they're going to yield 3%, 4%, you might as well keep your money in your savings bank account, because you'll get 2.5%, and in some banks you can get as high as 5% or 6% or whatever. So it doesn't make sense for them. Look at the other investment alternatives available to individuals. If you look at a retired person, he will have an alternative, which is senior citizen saving schemes, or the Pradhan Mantri Yojana managed by LIC, or the post office MIP. Or, for all individual investors who are risk averse, you have the classic, public provident fund, where all the return generated by the public provident fund is tax-free. So beyond that, beyond these measures, once these alternatives are exhausted, then, it makes sense. And why it makes sense for many individual investors, if an investor is a long-term fixed income investor and is risk averse, that is why he is one. The tax efficiency of debt fund comes in very handy. But what has happened with Franklin, that this might scare a lot of people. And the gradual reduction, because we have seen over the last 2.5, 3 years that we have been getting nasty surprises. And that is something which scares investors. Also, the whole mechanism of a mutual fund, whereby you might get moderately higher return, but you don't get a guaranteed return. And India has, Indians have been, fixed income investors because they have been used to high, absolute terms. They have been used to high fixed income returns. So when you tell somebody that you don't know how much you will get, and once in a while you come across such accidents, that's scary. But I would still feel that, there are investors who have fallen in the highest tax bracket. 3-year holding period, the tax efficiency, if you buy bonds or you make a deposit, all the returns have come down even there. The return that you get there is fully taxable. So you can actually manage your tax efficiency through a mutual fund. Hold it for 3 years, get into a risk-averse investment, relatively safer. You just have to be a little more careful. And once you do that, holding it for 3 years, indexation and 20%, that will reduce your tax bill quite substantially. So only for those individual investors, it makes eminent sense. And of course, companies have been historically the dominant investor base of the fixed income funds in India.
Okay, this is very interesting. So Dhirendra, essentially, today a retail investor, looking at the kind of returns that all these different debt funds are giving, and let's assume that, he or she is not in the high tax bracket. So let's assume that's out of the equation. But are you saying that today, keeping in mind the kind of returns that some of these debt funds have delivered, we'd probably be better off, in a PM via Vandana Yojana or the senior citizen scheme or the PPF? Because they do tend to give 6.5% and above returns on an annual basis.
Yes, absolutely. They are giving higher return, and if you happen to fall, you are not a taxpayer, then all your return is tax-free income. Only when you cross a basic threshold that it will be taxable. So for those investors, I think it is important to have. And once you cross the threshold, the problem is that those investment avenues, they have an investment, ceiling. You can't invest more than 15 lakh in senior citizen savings scheme, or you can't invest more than 10 lakh in the Pradhan Mantri Yojana. And likewise, there is some ceiling even for the post office MIP. So once you have exhausted those avenues, then you will have to look for this. But for the risk-averse investors who have historically never invested in any market-linked investment, for them getting used to the fixed income fund and uncertainty or some of these accidents, they are definitely scary.
Oh yeah, it just takes one or two incidents to really shake the faith of investors who were any which way has been pretty skeptical coming into a product that does have market-linked returns, not returns that are written down in black and white. Again, something that us Indians, on account of the higher interest rates, are pretty used to. Now, Dhirendra, we are in a low interest rate environment, plus there are fears that inflation is making a comeback, a solid one at that, in the global markets, perhaps back home as well. The most common instances when we go to fuel up our cars, petrol prices in Mumbai are at 101 rupees. So how do you invest in fixed income categories, especially when you have this threat of inflation? Or do you think then in such a situation, fixed income investments should be as low as possible and you should perhaps move more of your money towards equities?
Yes, the only way to methodically deal with inflation is to be in equity. And why equity? Because equity returns tend to get adjusted by inflation. Think of you are buying Maruti's share, and the company will make more profit because its product unit price will get adjusted by the inflation because of all the inputs. And to remain profitable, it will jack up prices. And in turn, it will increase the profitability, and in turn, the stock price will go up. And if we go by the basic belief that stock prices follow companies' profit, and profit gets adjusted by inflation, because all the inputs to any company's product or services, they will get adjusted for that, whether it be salary as an input, or any other raw material as an input, or any other any tertiary input. So rent, or the oil, power, whatever. So in that sense, inflation adjustment happens naturally in equity, not in fixed income. In fact, in fixed income, individual investors are at a great disadvantage. What we have seen historically over the last 20, 30, 40 years, that is going to undergo a radical change. Government has become the biggest borrower in the market, and they take money from the banks, they take money from the individuals. So in that sense, they being the biggest borrower, and they are running huge deficits, and the deficit keep rising. And when these deficits keep rising, and to service that, they have to borrow more. So unless there is a huge revival there, that situation is unlikely to change. And government is also the biggest determinant of the central bankers. They decide what the interest rate will be. And if they are the biggest beneficiary of low interest rates, they are unlikely to let it go high. I'm not talking of the current situation where the assumption of or the deceleration or of the economy is driving the lower rate. But generally speaking, that is going to be a conflict of interest between the central bankers and the lenders. So or savers in the society. So with that in mind, I think that the long-term outlook for interest rates is going to be low, and government is going to be the biggest beneficiary of that. And investors Indian investors have dual challenge. One is that historically they have been spoiled by a nominally higher return, maybe if not higher return than inflation. At least in absolute terms, it has always looked decent, 9%, 10%, though it may be barely matching into inflation, or maybe a little higher. The other is that Indian investors, they have not been used to a market-linked instrument, whether it be equity or whenever they have tried their hand in the last 20, 30 years. I'm talking of the naive, gullible individual investor. Whenever they have tried their hand, they have burned their fingers. And so they're very uncomfortable. They're very unsure of how to go about doing it. And now we look at, there's 15 kind of, about 16 kind of debt funds that only adds to the complexity. simplified, able to understand, be able to make an investment and derive all the return peacefully. We don't have those products, so it's going to be a very difficult challenge for investors to deal with it. But my understanding is that unless an investor embraces equity in a measured way, in a manner where he can get on board and can ride it with stability, or with in a and he's sold, he needs sensible advice, he needs great deal of hand holding, and if he's able to do that, then I think that will be it'll be very difficult for them to deal with this.
Well, absolutely, but let's hope that participation, really does increase. We have seen signs of that increasing in this last 12 odd months. But yeah, I think investors do need to get used to market-linked products as opposed to, products that assure you a certain amount of return and give you that. They don't work really well, in times like these where we have low interest rate regime, which could be the case for some time, plus inflation as well looming large. Dhirendra, thank you so much for joining us today on the Money Show. Appreciate you giving us your time. Well, we'll do one thing. We'll take a very short break, but when we return, we'll be giving you a glimpse of the new income tax portal. Don't go anywhere.